Today's market call is presented by FactSet, financial data and analytics powered by tomorrow. The 23rd of July. It is incredible. That's letter N for you playing our home games. Guy Adami, Dan Nathan, 1 o'clock on the East Coast market call. Within seconds, Carter Worth will be joining us. And I mean that within seconds. I almost slipped there. But before we do, Dan, how are you?
I'm doing great, Guy. I mean, I know this is really sad for you. We just got by July expiration, and we're going to get by whatever that future. What was the letter that you mentioned for July?
Well, that's letter N for N. July.
Yeah.
August, not that anybody cares, but since you started this, August is letter Q.
Yeah. Hey, listen, I just want to prepare you. There's a couple things I'm going to do to annoy you during this show. And I'm not going to use some goofy sort of like, it's
selling May and go away.
It's market of stocks, a market of stocks. You hate that, don't you?
Yeah. Sell the rips and buy the, you're not going to do that.
Yeah. No, I'm not going to do that. I'll do some other things. Okay. All right. What are we doing today, Guy? Give me
let's throw the rundown up there and let's take a look at this thing. Chart check. I just like saying that on stocks. Verizon. This is good. Amanda is so good. Can you buy me now? See that what she did there? Google and Tesla earnings preview. And we'll do a little audience Q&A if we have time. And as I mentioned, the aforementioned Carter Worth will be joining us.
Yeah, it's interesting, Guy. So here we are in earnings season. About a week and a half ago, we started earnings season with a lot of the banks. I think for the most part, I think investors were fine with what they had to say. And, there's a couple outliers. Wells Fargo had that huge gap down and looked like it was kind of down for the count a little bit and then filled in that gap within days and kept on going. That was also a theme, I think, of Q1 earnings as in April. Like most every gap that we were looking at got filled within a matter of weeks. And a lot of those tech companies made new highs. So the question here, is what are we going to be in for in Q2 earnings season? And, I'll just say it brings me back to last night, and this is a little inside baseball. Between every break on Fast Money, what do we do, Guy? What do we do?
We listen to music. We make fun of me.
We make a lot of fun of Guy. You take cracks at Melissa, but they started playing one of my favorite Bruce Springsteen songs between one of the breaks. And what that song was, Guy, is off the Nebraska album. It's an acoustic album, but this was an electric version of the song. What song was that? Do you remember?
I'm not sure. I do not recall.
All right. It was Atlantic City. And there's a great kind of lyric in Atlantic City, okay, which is kind of apropos, I think, for what we're going to talk to on the single stock line. He's saying there's winners and losers, and I'm on the south side of that line. Okay. So this is what's going on right here in the market with a lot of these earnings names. Maybe Amanda can throw them up, and we're going to bring Carter in a second to kind of go through some of those charts. But it's really kind of interesting, some of the moves, some big moves, Guy, of companies that reported last night or this morning. And the Spotify is a bit of an outlier, and everything else is south of that line.
Yeah. Well, Spotify is Spotify specific. And if people are going to say, okay, because it's up, you're saying it's no, I just think they happen to be operating better. So I think it's an operational thing. I don't think it's necessarily a tell on the economy or the broader or any of those things. The flip side of that coin, UPS. Now, clearly UPS has UPS specific issues without question. But Amanda, I hate to do this to you or Jacob. Throw up a UPS chart over the last 5 years. And, this is a stock that one would think if the economy, especially here in the United States, was as gangbusters as at least the market suggested, this would be a stock that would be doing extraordinarily well. And if you look at it, it's anything but. I mean, look at that down channel that this stock has been in for the last few years, as it turns out. And we're approaching, Dan, you saw that gap. You go all the way back to 2020, that gap higher. Well, we're on the precipice of filling what has been a long-standing gap on the downside. So again, I understand that a lot of this is UPS, but I also would throw out the fact that a lot of this has to do with what's going on, I think, in the economy as well. And I do think UPS is a bellwether name in terms of just trying to figure out what's happening out there.
Yeah, no doubt. I mean, we'll hit Carter with a bunch of these names in a little bit of a speed round. Guy, one of the first things I was going to aggravate you with, you're obviously in the studio away from me. You see what I'm wearing here? Like it's one of the things.
Yeah, I see it. It
activates you, So
yeah. Well, okay. So Amanda, I
brought it up. It's fine, dude, because you're going to say the Wall Street D.
The Wall Street, I'm not going to curse because apparently, you get flagged and things, but. Yeah. Every Wall Street Johnson, and you know who you are if you're watching this. You typically go in a pack anywhere from 4 to 7 of you. You all seem to go to lunch at the same time, and you all have the same uniform on, and you look like imbeciles. I mean, if you think it looks cool, you're doing it wrong.
All right.
Now, I understand why you're wearing that. That is nice, but
Yeah.
you know my view on this. This is not something that G Swizzle wears.
All right, by this, so does that mean the vest that I got you that looks like this, you just don't wear? You threw it in the trash bin or something?
Throw any. I just, I don't.
Right.
Now, okay. Here's the other thing. So if I am wearing a vest like that, typically I might have like a white T-shirt underneath it. So I'm trying to intimidate some people, but I'm not wearing it as part of my work uniform, I think, it's a weekend look.
That's fine. It's a very warm day outside. It's very cool.
It is warm.
It's very cool in our studio. All right, let's bring him in, Carter Braxton Worth, because
he would agree with me, by the way.
I know. We're going to start with the macro, and then we'll get back to all those stocks we were talking about. Carter, what's up, my man?
How are you?
Carter, just break the tie here on that whole vest
on
thing.
there. It's all good.
Okay.
Yeah, a lot of movement. I mean, think today, big. I mean, look. UPS, because it's such an important bellwether economically, but look at GE. GE is almost twice the market cap, and it's up 9%. Danaher, third or fourth biggest healthcare stock, up again 3 times the market cap of FedEx, twice that of UPS. It's up 6-7%. So it's ever thus, right? And that's the nature of and the risk and the reward of going ahead of earnings, right? Making a bet and then getting paid or getting punished.
Yeah, no doubt. Do you want to start? We missed the GE, by the way. I didn't see that. I know that they mentioned it on our Fast Money call just about 20 minutes ago. Do you want to start with, the major indices? We took a look at them last week. Again, we're still waiting for that similar sort of 10% sell-off that we got from July of last year down to October. We thought maybe we just got things started a little bit, but this is an interesting chart here, Carter.
I mean, it's a right angle. It's a channel. It has all the things that one can appreciate with the eye. And we have now a 3% sell off to the lower band. If you just take the time frame of the channel, that's what's important. That was our last meaningful sell off, right? About 6% on the April low. And so basically, you're talking about the third week in April to the third week in July. You have a 3-month move. It is annualizing. It's a 15%, and you're annualizing at something like 55-60%. That kind of thing is not sustainable. And so counter trends, this is one, normal enough. Hard to know. Does it stop here? For now it is. My hunch is otherwise, but it is within the channel. By contradistinction, just take a look at the NASDAQ 100. We might be able to toggle the two, but the NDX it was up from its low. It's annualizing at something like 70-80%, and now it's broken trend. Obviously, we know that was the darling, and they both have gaps. The first down gaps in a while, the only unfilled down gaps in the history of either index, because each is at an all-time high. And so you pick your bet, you make your bet. I mean, what we know, Google, Tesla, a few of these come out good, that's going right back into the channel. They pull up short, fall, more to go. And one could say, so that's pretty elemental and obvious. Thanks for that. It's all it is. We can't know. You can make bets on those, but that's what will determine whether this break in trend continues.
Yeah, let me jump in here real quick. What I would submit, Carter, and I think you have some opinions on this. The worst thing that could potentially happen here, I think, is if we were to go back and test that up channel, so the lower band of that up channel, and subsequently fail, as opposed to sort of falling off the cliff here, washing the market out, and then having a constructive move. So in other words, if we were to trade back to the lower band of that up channel and fail, which we've seen before in a number of different things, that actually formation-wise is worse than just sort of collapsing in the here and now.
Yeah, I mean, both are negative. If you were to rally here, fill the gap, and draw in more money, only to then crap out, as the expression goes, that would hurt more people versus continuing lower just from here. The consensus is, of course, generally based on, if you look at sell-side publishing strategists, if you look at the money flows, people are basically playing for higher prices between now and year end.
Those are great charts, and it's interesting, Guy, how you mentioned that. I mean, there is a gap to be filled if it does get going. It doesn't get rejected at the lower band here, but the NDX is obviously in the hands of this kind of Mag 7 for the next couple of weeks or so, and it's going to be. This is the other thing that's going to aggravate you, Guy, because we don't get NVIDIA's earnings until August 28th. I think that's the confirmed date. We got to come up with a new name for the next couple of weeks. I was thinking maybe the Superb 6, something like that. I'm sure
Don't
that's
do it. Please don't do it. I mean, it's just as I said, I say it all the time. As Damone said, I woke up in such a good mood. Your own, but that another trying to trigger G Swizzle here. So we mentioned we'll do a little bit of a speed round. So we looked at Carter's charts. We threw up a UPS chart, Carter, but let's throw it up again because we've been in this down channel. We're smack in the middle of it. You can see where it goes back to. Again, as I've mentioned a number of times, the longer the duration, I believe, the more important a trend line or a channel is. And this one goes back approximately 3 years. So you can see a series of lower highs, a series of lower lows. We're about to do the same. As I mentioned earlier, Carter, before I think you jumped on, it appears as though we're about to fill a gap that was created to the upside way back in the spring of 2020. So there are a lot of things at work here. I think proper work suggests that although we're in the middle of this channel, there's a very good chance that we touch down to the lower end of this down channel and then potentially bounce. So what are your thoughts here in terms of UPS?
Yeah, I mean, look, there's bull phases and bear phases. You have a bull phase from the COVID low to the highs of January 2022, essentially 75 to 225. You're in a bear phase now. And in general, it's right to stay on the right side of trend. The real thing that's quite remarkable is that UPS as a business could be this close to its COVID low. To think that's getting to be, 4 and 5 years ago. How could it be, right? That this, and it's not as though there's a whole bunch of competition, right? There's Federal Mail at the country level, but basically DHL, FedEx, UPS, it's kind of duopoly, traveling. That I think there's two ways to look at this. From a charting point of view, it's terrible. Get rid of it, sell it, stay short. If you're long, just punt, move on. There are other people who are responsible for doing 3 to 5 year DCF work and are trying to come to a judgment whether they should now, just as everyone else is panicking, start to build a substantial position in UPS. And what that means, of course, is there are different players with different time frames in the market. And that 3-year player has every reason to do or think just exactly as I articulated, just as the tactical player has every reason to say, look, something's wrong. I don't like the way it acts. Get rid of it.
Something's wrong in General Motors. And let's go to this chart because, again, General Motors has been a very strong performer over the last almost year, quite frankly, if you look from that move we had since November until now. But again, these are our channels, Carter. I'm not suggesting we're right by any stretch, but you can see what we sort of did here. It appears as though we've pierced with today's price action this up channel that we're in. There's still that huge gap in the downside. And again, I'm not suggesting we're going to fill it anytime soon. I'm just pointing out that it's out there. I mean, does this appear broken to you? Because when you see a move of this magnitude, the stock's down almost 6.75%. I think it seems to be important to me, given the run that we've had recently.
Yeah, you're allowed to look if it was to the penny every time, of course it would be easy. We know it isn't. You're allowed to violate a trend from time to time, but it needs to stop here if in order to save itself. But the real message, of course, is that Ford's doing the same thing, and we'll hear from Tesla shortly. But Toyota Motors down some 20% from its peak. Generally speaking, there's a lot of duress, at least in the shares, the global auto market.
NXP is an interesting company. It's a $70 billion market cap company that I think is down approximately 10% today. This is a stock that's had a tremendous run to the upside. Along the way, you've seen some pits and fall. You can see it in this chart. We're in the midst of one now. Again, our channel, our up channel, somewhat wide, I get it. Seemingly in the middle of this up channel, I get that as well. But one would think that, we touched 3 points on the upper end. It stands to reason that maybe logic suggests it will go to the lower band, which, by the way, off of time decay will coincide with the 200-day moving average. So sort of some thoughts here. I think they're probably going to be
Yeah,
similar to
similar.
your GM thoughts, but I'm
Mhm.
curious as to your ideas.
Yeah, likely to continue, I would think, and reach the lower band. Um, is that sort of guaranteed? Of course not, but that's what these are tools. It's compass. It's a roadmap. It's a flashlight in the dark, and this is what the tools and the point to. So go with the findings.
Yeah,
Spotify is. Oh, sorry, Dan. Didn't know you
No,
were back. Go ahead.
yeah, I was gonna say that it's interesting, Guy. We're gonna look at Spotify right here. That we had Netflix a week ago or so, and they
Hmm.
had a pretty good subscriber beat there. And like the price action was somewhat muted. I think at first it was down in the aftermarket, Guy, but then it rallied back, and then I don't think we had much of a move at all. And this morning, after I was looking at Spotify's results and their subscriber beat, the stock was up 15% or something, making new all-time highs. And just going back to Netflix, it closed down, 1.5% the day after their earnings. Now, we know that last week was not a great week, right, to be a high valuation sort of tech name. But Carter, when you see a move like this to new highs, it's going to come in a little bit off those levels. Is that something that again, you want to fade just because maybe your view on the broad market, or is this something that you think is kind of powerful? And again, if you don't like the trend lines that we made or the channels that we made, please tell us,
No, I
because
mean the thing is, and here's the thing: it's not, you can't make them. They make themselves. That's the point, right? I mean, the charts are the charts. I can't make them, and so they are what they are. Are we talking about NXP? Oh, here we
no,
go.
we're
Great.
talking about
Okay, we
spot.
have a change. Exactly. Got it. Yeah, heck of a move. Um, is it trading on the low of the absolute range today?
Yeah, I think it is. It's very close to it.
Yeah. So we have a bit of that going on, right? So when you fade, you can't quite stick your landing, and then the risk is, of course, it just drifts and fills in its own gap. Just even happened today, or
Yeah.
shortly thereafter. It feels a bit impetuous, a bit sort of knee jerk. My hunch would be to fade it.
Take a look. If we can do this, Amanda, real quick, go back to a 5-year chart, and you'll see that in the winter of 2021, I think it was February, Spotify made what is still its all-time high, I think north of 360. And we didn't get all that close today, but with each passing day, we're getting towards levels that were obviously pretty huge resistance. So when you see these extended moves like this, especially on a day we're going to see some unusual volume just in terms of the number of shares that have traded, Dan, I think you're sort of pushing towards the envelope here in terms of a long position. So I think proper discipline suggests, if you've been enjoying the ride to the upside, and it's been pretty monstrous over the last 6 to 9 months, you got to do something here. I think, again, it dictates that you either take a third, a quarter, half of your position off, maybe sell some upside calls, buy some protect, whatever the hell it is. But to sit on your hands here, given this move, I think is foolish.
Yeah, I would just say this, and one of you guys, I think it was Carter, made a great point. Let's pull up like a 2, 3 day chart of this. You see the gap, but you also see where the stock is trading, at the lows. So it's, like 4 or 5% off those highs. So that's something that you just kind of want to give a little credence to. The last thing I'll just say, Guy, is like I look at this thing, and this is the first year that they swung to, positive net income here. Okay, so when you think about this on a adjusted basis, they're supposed to make maybe $1 billion this year on $15.7 billion in expected revenue. So the profits are just starting to come here.
Mhm.
And I look at this thing, basically 19 expected percent growth in revenue this year, 15 next. And I look on the earnings front, again, this is coming off a swing from a loss of 273 last year to a gain of 487. But then you see 46% expected EPS growth next year. So again, trading 42 times, maybe it's cheap. I don't know, but it's literally, if you start to see, subscriber growth moderate a little bit, you'll start to see a deceleration in revenue and earnings.
This is one that, again, you can, depending on your dogma, you can say, what, it's cheap and they're coming into their own and they're going to grow into that valuation, or it's extended. I just look at it through this point, the technical lens. I overlay a little fundamentals and say, we've seen moves like this before in some names. And when names like this get extended, they typically do what we call a back and fill. And I think that's sort of what we're setting up for now. Comcast is a name that's near and dear to us. And, Carter, we have this down channel. By the way, we're not suggesting it's right because you obviously see the violation to the upside that we had, but you can see what seems to be a pretty well-defined downtrend. What is undeniable, though, is that we recently traded up to the 200-day moving average. And given today's action, I think it's fair to say that we failed. So when you look at Comcast, what are your thoughts here?
Yeah, poor relative strength, bearish price volume correlation. There's just no thesis to be long on a technical basis. It's either, hey, I don't want to trade it, or just stay short, press the short. Something cannot be right. A stock that's over the past year done this, as opposed to what most stocks have done, which is they're going up.
By the way, you just might as well throw a quick Disney chart before we take a look at Verizon. And by the way, Dan has a trade in Verizon. But let's look at Disney because, again, another name that can't get out of its own way. It's interesting that Nelson Peltz, I remember the day, Dan, we were sitting on the desk together. It was announced back in, I want to say, middle of April or so, or late March, middle of April, that he got out of his stake in Disney. And my God, he sort of top-ticked that thing because, there was only a couple of weeks where it was trading north of about 115. And since then, we're right back down. So I guess my point in bringing this up is it's not just Comcast. It's sort of the entire space, ex-Netflix, that seemingly can't get out of its own way.
Yeah, what's interesting about this one, and Carter, this stock was down, Comcast was down maybe 4.5%, 5% at its lows today. So it's kind of coming back pretty hard. And Disney hasn't seen an uptick all day long. And Disney, which was down in sympathy with Comcast, and they don't report for a week and a half or something like that, is down more than the reason why it was down to begin with. I just think that's pretty interesting, Carter.
And just unrelenting. And sometimes, look, we're all tempted to say, is it oversold? Man, bet on a bounce. It's usually wrong to do, right? Just resist trying to just step in. It's reasons why we have the catch the falling knife adage. It's up there in the great 5 or 10 with don't fight the Fed and first loss, best loss. These have become things to know and learn and adhere to because they are true.
In our rundown, we teased Verizon. Can you buy me now? Well, let's take a look at a Verizon chart. And, we're going to sort of pontificate a bit here. You can see this sideways action we've been in basically for the entirety of this year. It's sort of on the lower end of the spectrum, sort of 38 to 43 on the upper end. We've been bouncing around. You see the moving average, Dan, is actually starting to slope in a bull's favor. And you have a trade here in Verizon.
Yeah, what really struck me about this was basically, the lack of upgrades that they're seeing. And you see seasonally weakness in this in front of like an iPhone launch in the fall. I don't think you have to kind of get as excited as some of the analysts are about Apple's upgrade cycle to basically say, yeah, the seasonality turns into something else once we kind of get out of the summer here. So, you see this gap, you see the technical setup here, back to that moving average, you see the range to Guy's point that it's been trading in. I suspect it remains range bound. I think the first tick yesterday after those results was about $40. Okay. So when I think of this, and I also say to myself, I know that we don't buy stocks specifically because of the dividend yield, but if the expectations are that the Fed is going to cut 25 basis points in September and then again in November, and that we are going to have, let's say, every other meeting, a periodic sort of 25 basis point cut, stocks like Verizon are going to come back into favor. It pays a 6.8% dividend on an annual basis. And so looking at the stock here makes some sense. I want to play it through through options here, because to me, I think there's some interesting setups here. I want to look at a call calendar. So today when the stock was trading at 39, what is a calendar? I'm selling a shorter dated call, and I'm buying a call longer dated of the same strike. Okay. The premium that I pay for this calendar is my max risk right here. So let's just look at the trade I'm doing. August, October, 40 strike call calendar. It would cost you about 65 cents. You're selling one of the August 40 calls at around 35 cents, and you're buying one of the October 40 calls for $1. So 65 cents is your max potential loss. And if you get to August expiration and the stock is 40 or below, you see basically that the August call expires worthless, and then you end up owning that longer dated October for about 65 cents. And at that point, you get to play for all the potential upside that you might have, as investors might start looking at high paying dividend stocks. And then also if investors are getting excited about what Apple might release in late September.
Interesting strategy, because you're mitigating obviously the cost of the October call by, I can do the math, by 35% by selling the August 40 call. And what you're basically saying by doing this, and I'm not speaking for you, but this is the way I interpret it, is, you're through the catalyst. You're basically enough time where you think the stock is going to sort of grind and trade sideways. So you'll take basically all that premium that you sold, you will earn. And then you have the upside of the $40 October calls, which gets you through the Fed meeting, to your point. So the structure and the setup, I think, makes a lot of sense, Dan.
Yeah, and again, listen, you could buy that 40 call
Yeah.
in October, but if the stock just kind of goes sideways or gets maybe back up to 40, it's just going to be decaying every day. So this strategy kind of helps with that decay. And the last thing I'll just say is, like, let's just say it gets near 40 or gets above 40 between now and October expiration. It's going to start trading like stock, right? So let's just say you're a week before August expiration and the stock is 40, 50 or something like that. Well, it's going to be a 50-cent loss or whatever. But if it comes back in and let's just say it's trading at 40, it's going to trade at a small premium to that strike. You could always cover it and stay along that October. Carter, really quickly, what do you think of these levels here? Do you think that
Yeah,
the
good.
support level makes sense?
I do. And also, you do bring up the point. I mean, dividends are a kind of a curious thing, and investing for dividends, because they can be wiped out in 1 second. But for what it's worth, the dividend, what do they pay? About 68 cents a quarter, and they're earning $4 or $5. It's covered, and these are heavily indebted companies, AT&T and Verizon, the most indebted companies in the country, but they use that debt to effectively become bonds, which is what they are. And if and as that dividend is good, and that is the presumption, you do have that, regardless of one's appreciation, to hang on to. But I love the levels.
Let's take a look at Google, because we're talking about some earnings on the horizon, and the implied move here is plus or minus 6%. That's our up channel, Dan. Whether or not that's justified or not, again, the charts are sort of in the eye of the beholder. But Google's had a pretty good run here. The point that I've been trying to make is you've seen some pitfalls over the last couple of years on the back of earnings. Although the stock recently made its all-time high, my concern was, you might be setting up for one of these sort of downdrafts, which we've seen before. So curious as your thoughts on Google here, Dan.
Yeah, and we spent some time last night on the desk in Fast Money talking about this. And what's interesting to me is that after that 10% gap on earnings, you can see, where it kind of touched that. It really helped create that trend channel, and we'll let Carter talk about that in a way. And then after it consolidated a little bit, it kept on going. And, the sentiment in this name changed a lot over the last year. It was often thought to be a big laggard, despite all the spending on their generative AI offering. They first called it Bard, and then they called it Gemini, and they called it Gemini Advanced. And all of a sudden, we're starting to see contextual answers when you go to Google and ask it a question. It used to be a bunch of blue links. So the question that I think a lot of investors have to ask themselves, if you remain long this stock, is will there be a near-term transition in ad revenue as you don't see as much of the blue links that people are going to click on, and that's how they make their money, right? Because they're giving you this longer answer that's costing them a lot of money to create, right? Rather than that old source of just pumping out the link. So might we see CapEx a little high? Might we see revenues a little lower? And might we see a cautious guide? I think that's what you're kind of getting to, Guy, a little bit. And then the other thing, and I mentioned this on Fast Money last night, this year, gross margins are expected to be 68%. Next year, they're supposed to drop to 62%. That's what the street is modeling. And I made the point that I can't remember the last time I saw that sort of year-over-year decrease in gross margins for a mega cap tech company. So again, there's room to the upside on the margin number if there's any confidence that they're going to lower CapEx and then revenues continue to go that way. But I'm not sure about that. So again, 6% implied move in either direction also means that the weekly call at the money is only 3%, or the weekly put is only 3%. So depending upon how you're positioning, you might be able to cheaply add leverage or protection in either way. Carter, thoughts here on that trend channel, because it looks an awful lot like the NDX.
Yeah, I mean, it's a big move off that low. That's 45%. It's a bit above trend as measured by the moving average. And so the question is it going to be fair? The last quarter was a big resounding positive. Again, there's no such thing as good or bad earnings. There's good results in terms of price action. Stock gapped up 10%. The presumption is you get a second gap.
Let's take a look at Tesla, Dan, something near and dear to your heart. Obviously, a stock that's probably rallied some 90%-ish off the low, but a stock fairly that's still significantly lower than its prior all-time high. And you've seen, listen, we saw a move of this magnitude last year as well. So it's not like it's unprecedented. So let's take a look at Tesla and earnings as well.
Yeah, so 9% implied move in either direction. Obviously, this is a stock that is notoriously volatile after its earnings. And if you just go and you look at the last 4 quarters, I mean, we had a 12% gain last quarter. We had a 17% drop the quarter before that, and then down 9%, down 9%. And so one of the things I think is interesting, Guy, and we talked about this heading into their Q1 delivery number in the early April, we just said that estimates had been coming down so dramatically, you know what I mean? And it gapped lower on that. But for the Q2, they've been coming down dramatically. And what did the stock do? It had that big bounce. It consolidated, and then it started to rip on some other things that had nothing to do with making cars, right? And I think that's a really important point. So once again, the focus, as they report tonight, and investors are going to be digesting, is like, what are the auto gross margins, right? Have they shown any improvement? Because if this price war is still going on and they haven't meaningfully increased their deliveries in this quarter, which are expected to be down year over year, then I think you see the stock pull back possibly to that 200-day moving average. It's making a little bit of a flag here. You see that kind of 2-year downtrend that it's been in. But if you look at it on a 5-year basis, it's gotten above that downtrend from that kind of 400 level in late 2021.
I don't know how they're going to I don't know how margins are going to be better than the street is expecting. And I've thought for a while that it is a margin story. And when that was the story, the stock was acting in kind, trading to the downside. This recent run's been predicated on a couple different things. Robo-taxi. I also think, and I don't want to talk about politics, I want to move on, but I also think a lot of this move is potentially on the back of another Trump administration, which historically has not been favorable, but they seemingly have changed their tunes towards EVs and Tesla specifically. So we'll see.
Well, hold on. I mean, like, one of the first things that former President Trump said at the RNC is that he immediately wants to get away from these EV subsidies. And when you think about that, I mean, Tesla would not have had the adoption of their cars in the US over the last 5 or so years without those subsidies. And I guess Elon, who's already committed tens of millions of dollars to a super PAC to help get Trump reelected, said, well, maybe we don't need them. Like, he's kind of kowtowing to it a little, which I find very surprising, especially as they're competing on price with some really low end, Chinese or high end cars at a low price. They have to make their cars, especially where interest rates are, that much more attractive. So I don't get that whatsoever. And you make the point, like, they diverted so many of these H100 chips from NVIDIA. You remember, like, about a month ago, and over to XAI, Elon's other company. Well, wouldn't you think that they need those high-end chips to power supervised full self-driving? I mean, they don't use LiDAR. They use basically what is generative AI to kind of see what's out there or whatever. So I just kind of find it pretty curious, and I'd be surprised to see a meaningful gap unless you see guidance that talks about margins going back up above 18.5% or so. But Carter, enough of the fundamentals, as you like to call it. What do you see in that chart? This is the 5-year. You can draw that down.
Let's go back to the shorter term. And so we have essentially a doubling, right? The stock has this sort of very powerful recovery, jumping What was the low there in May? It was probably 140, and
I think.
it's 138, and it goes to 270 here, 95% or thereabouts. And now normal reaction, meaning after something gets steep and uncorrected, some people sell into it. They think, oh, I've got profits. Other people try to short it. That halts the advance, and then it starts to flag. That's why they call them pennants and flags. You can see the minor series of lower highs, higher lows. It's pointed. It looks like a flag. That's what it's called. It's nothing other than consolidation. And then 50-50, does it get resolved, the standoff, the consolidation by the next up leg, or does it fall out of the pattern and drop? My hunch is that it's not going to do well. I don't like the action in Ford and GM. I would be not wanting to be long going into the print.
Take a couple questions here from Jody Edmondson. I know Jody's here every day. Speaking of falling knives, is ASML a buy? I think ASML is the largest tech company in Europe still. Obviously, it's had a pretty precipitous drop. The answer is, I don't think at 932 it is, but if you were to get it down to 875, which was at the time the prior all-time high in September of 2021, and you can throw that chart up longer term and you'll see what I'm looking at, then it gets interesting, and you can see that sort of prior high. So, oh, it's actually higher than I thought. So 880-ish so. So, right here theoretically should be support. I didn't realize it got that low the other day. So maybe we actually did capitulate on the downside. But you see what I'm looking at in terms of the horizontal line from the prior high. Maybe I didn't realize it got that low. I guess it was yesterday. So maybe this is one to take a look at here, Dan.
Yeah, Carter, and this is maybe a question for you too. So this stock last week gapped down on fundamental news. Okay, they reported their earnings, and investors in a raging bull market for semis did not like what they saw here. So you just mentioned in Google, and I've heard you say this before, that when you have a powerful gap to new highs, the way we did on the 52-week highs, with Google after its results last quarter, that you commonly see a second gap there. Does that hold true? Obviously, I'm assuming it does for downside gaps.
Sure, absolutely. And the risk here is that we fall to 800. That's where real support comes into play, and that would also constitute a gap fill. If we look at the 5-year chart, or the longer one that we had, this is, think about it. From the COVID low, just to put this in context, it goes from 200 to 800, a 4-bagger. And then in the 2023 bear market, it drops 59%. The Qs dropped 37. The S&P dropped 27. It just shows the beta, the risk reward associated with this great winter. A 4-bagger leading up to then a 60% decline, and now it goes up 5x from its lows of 2022, right? 400 to 1,000, and here we are. What's important is that means it's a cyclical business. And it's important to say that if you were to just put CTAS, for instance, Charlie, Tom, Apple, Sam on here as a 5-year chart to make a point about non-cyclicality, you'll see an entirely different chart. And if that can come up, if not, I'll make the point without the visuals. But the point is, this kind of variability, it means one thing, right? This is not, it's a growth business till it isn't, right? It's a cyclical business all the same. My hunches would not be long here. I would be worried about the next drop and gap.
Mitch is asking about Robinhood, Carter. I think it's down a couple percent today. It's had a it's had a tremendous run over the last 6 months. Feels like it may be sort of running out a little bit of steam here. Let's take a look at a Robinhood chart. By the way, full disclosure, I still think there's some upside here, but I understand, when you have these sort of nonstop moves, lower left, upper right, at some point it's going to take a breather.
Yeah,
sorry, I thought you were. I'll go. Look, pull this back a little bit so we get a little more perspective to just show where it came from. And again, this is the real story. This took forever to base and bottom, and sometimes they're value traps, if you could even use the word value in a stock like this. And then finally, of course, it does start to turn. So is it nascent, young? The implications 60, 80, all the way back to the high, or the short-term chart again, is it already shot the moon? It's so steep, and it's both. There is no answer. It is overdone in this term, this time frame. I would trim or reduce. On the larger base, one say this is just getting going, and that is the conundrum.
Well, here, and let me just kind of weigh in from a fundamental standpoint, Guy. I know that this is one that you've been pounding the table. I remember hearing you talking about it on Fast Money below $10. Okay, and again, what a heck of a run this year. And I just when I see a company, okay, inflect on the earnings front, they just went from negative earnings last year to an expected earnings, so down 61 cents in earnings, and up 53 cents this year with growing revenues. And I think about what are some of the catalysts that might be. We just saw that Ethereum ETF that has been approved. We know that this is a preferred, platform to trade crypto. And, I think giving folks who are interested in crypto more opportunities or more options to trade it, I think that's pretty interesting too. This is a company that's growing, expected to grow revenue this year 34%. So to me, it definitely looks like a buy on pullbacks. I see what you guys see. The idea of a back and fill guy makes some sense, and they don't report, at least I think, until August 5th or 6th or 7th.
This is a tough one. Eva Wu's asking about ServiceNow. Dan, I know you've looked at this. What I'll tell you is, this stock in February traded north of $800 by, I want to say, Dan, and you know this better than I do, but by the end of May, it was $650 stock, traded right back up to that level. Now we've been selling off recently. I look at this and say it's probably a no touch here, but that's just me.
Yeah, what's interesting, and we talked about this a bunch, is that as most of an investor focus has been on generative AI, and listen, ServiceNow, Workday, Adobe, Salesforce, all these companies are going to be using generative AI to kind of make better products and services and integrate with other products and services that their customers want. But for whatever reason, right now, they are just out of favor relative to some of those other larger names. If I look at Salesforce is down in the year, Adobe's down in the year, Workday's down in the year, ServiceNow is only up 8% on the year. But here's the thing about ServiceNow, expected 25% earnings growth this year, 20% next, trading at 56 times this year and 42 times next. And I just say to myself, okay, well, we know that enterprise budgets, you know what I mean? They're not going up materially right now. And if budgets are being diverted towards spending on generative AI, they're probably coming out of some of these enterprise software companies, butts, if you will. So if the expected growth, earnings and sales, above 20% for the next 2 years, then maybe that's something that you want to buy on a pullback, but I'm not sure you want to buy it now, despite what looks like a pretty long-term base. Carter, thoughts on the chart here?
Yeah, pair of twos. It's and one could say, but yes, but when you play it for the breakout, it's better I'd rather pay 800 and forego. I'd rather play it if and as, right? It's in motion and starting to threaten and tempt and get through the former highs. Here and now, no trade.
Elf Beauty is the last one we'll talk about. We got a question here. Does it look like a classic double top? I think Elf made an all-time high in March of this year, like 220 or so. Had a pretty precipitous drop-off, like many stocks. Traded right back up to that level, I want to say at the end of June. Here we are at 180. I look at this and say, you know what? The setup suggests we're going to touch the prior support around 155 or so. Carter probably looks at Elf and says, you know what? No touch here. We're basically traded down to the moving average. What are your thoughts here, if any, Carter?
Well, on a long term, this went from 20 to 200, right? So there are 10 baggers do exist. But here now, I'm with you. I would say no trade. It just is so unclear. We're looking for clearly defined setups where we can say, all right, we know if and as this breaks out, why we're in the trade and what we're playing for. What are we playing for here? A bounce, but we just bounced off the moving average. We couldn't make that new high. Now we're back at it. It all feels a bit sluggish. And yet, does that make it a short? No, particularly. It's just no trade for me.
Dan, the time goes by extraordinarily fast, and I believe we are now find ourselves in week 10, not of the NFL season, but of something that we call Market Matrix.
Yeah, so this was a new podcast that we introduced 2.5 months ago. We're really excited about it. They call it the MRKT Matrix. You know who reads it. It's Brunson. It's not Guy or it's me. We curate the stories, what we think are probably the most important market stories, business stories generally. So it's an AI-generated podcast. We bang that text into a voice bot. It's called Brunson. So check it out. We're really excited about it. We think it's a pretty useful thing. At the end of the day, it drops right after the market. And, download it, rate it, review it, share it. That's how people find it. One other piece of housekeeping here, Guy. Yesterday, I had a great conversation with Gene Munster from Deepwater Asset Management. We went over the superb 6 because we're leaving NVIDIA out of that. This is a pre-earnings sort of review. And if you're focused on Google and Tesla the way we were today, go there, download it in your podcast store. That's OK Computer, OK AY. And in the meantime, you just listen to the Google and the Tesla, and then you can catch up later in the week for those other 4 names. It was a great conversation. So go check that out.
In your favorite podcast store, please don't wear vests if you go out to lunch. Anywhere from 4 to 7 of you look like Johnsons. I want to thank the great Carter Braxton Worth. I want to thank the audience. We will be back tomorrow. I don't know if EYT is with us or not, but if she is, it'll be great to see her, Dan.
Yeah, she might be. She might be back. She was on a little bit of a trip, so we're excited to see Liz. Carter, thanks so much. Carter will be back with us on Thursday.
Thanks, everyone.
Bye.